Welcome. In this lecture, we're going to talk about liabilities. On the topic of liabilities, we know that a liability is a legal obligation that a company has in which they have to pay an outside party known as a creditor. Usually the payment is by way of cash. In some cases, you may have to deliver goods or services. In the first learning objective, which is what we're going to cover in this video, we're going to talk about current liabilities. So the focus is on the word current. So liabilities, again, are legal obligations that have to be met sometime in the future. When we say it's a current liability, we'll see what criteria needs to be satisfied for a liability to be called a current liability. So this is a debt that the company expects to pay from existing current assets or the creation of new current liabilities. And this payment is going to be made within 1 year or the operating cycle, whichever is longer. So both conditions should be satisfied for it to be a current liability. So what are some examples of current liabilities? Notes payable, that is short-term borrowings. Accounts payable, this is you have purchased from vendors on credit and you owe money. Typically it's 30 to 90 days. Unearned revenues, this is basically customers have made payments to you in advance and you need to deliver goods or services. Accrued liabilities, these come from adjusting entries at the end of a period, end of the month, end of the year, end of the quarter, as the case may be. You're looking at a variety of taxes, salaries and wages payable, and interest payable. So let's take a look at an exercise in which we're going to work on all of these liabilities. We'll do the journal entries, post them into the T account, and then show how we would present them in the financial statement that's in the balance sheet. Liabilities go into the balance sheet, and we'll see how to do that. So let's switch gears over here and look at an exercise. In this exercise, we're told on Jan 1st, 2022, the ledger of Romano Company contains these liability accounts. So this is just 3 of the liabilities they're talking about: accounts payable, sales tax payable, and unearned service revenue. So for these 3, I have T accounts. We'll get to them a little later. They've given us transactions that have happened in the month of January. And then they've given us information that we need to do adjusting entries for at the end of the period, end of the month. So let's start out with each of these transactions, see how we will do the journal entry. So the first one is Jan 1st. We borrowed $18,000 in cash from Apex Bank on a 4-month 5% note payable. So it's a simple transaction. I have borrowed money. So for the business, cash is coming in. So cash is debit, cash increases, and the amount is 18,000. Obviously, I have to return this money, and that account is going to have, the word I'm going to use is notes payable. The key word over here is payable, indicating that I have to pay the sum of money to the outside party, that is Apex Bank. I'll also write down what the terms of the note are. This is a small exercise, but it's usually good to keep track of that information. So I have cash debit, notes payable credit, $18,000. I'll post everything into my T accounts after I'm done with all my journal entries. On the 5th, I sold merchandise for cash, totaling $6,254. This amount included sales tax. So let's take a look at this journal entry. So on the date of the transaction, January 5th, I collected cash from my customers. I know the amount of cash that I've collected. Now this money has to be credited to 2 different accounts. One is my sales revenue and the other is sales tax payable. So this number includes the sales tax payable, which is 6%. So the sales revenue times 1.06 would give me the cash. So another way to back into the sales revenue is I take this number and divide it by 1.06 to arrive at the sales revenue. The difference between the cash collected and the sales revenue is the sales tax payable that I have collected. This money that I've collected is not mine. I have collected it on behalf of the state government and I need to remit. The word remit means I need to give it to the state government sometime in the future. Of course, it's going to be very near in the future. That's why it's a current liability. On the 12th, I performed services for customers who had made advance payments of $10,000. So if you recall, I had $19,000 in unearned revenues. Now they're telling, I've been told that on the 12th, I did some of the work, $10,000 worth of the work, and now I can credit service revenue. So this liability decreases. Unearned service revenue is going to decrease, so I debit it, and I credit service revenue, and the dollar amount is $10,000. So in this case, I'm not incurring a liability. In fact, I'm decreasing the liability. On the 14th, I paid the State Treasurer's Department for the sales tax collected in December 2021, the 6,600. So if you recall over here at sales tax payable, I'm paying up that amount now. So it's usually due within the next month. So on January 14th, I'm making that payment. So if I'm making a payment, I know cash is credit. Again, my liability is decreasing, so I debit the liability account sales tax payable, and the amount was already given to me, 6,600. That information was there in the beginning balances over here at the beginning of the month, and in the problem I was told it's 6,600. On the 20th, I sold 500 units of a new product on credit at $48 a piece, and 6% sales tax is collected or is charged because it's on credit. I've not collected the money as yet. So the journal entry is on January 22nd, I'm going to debit accounts receivable, not cash, because it's on credit. I'm going to have sales revenue credited and sales tax payable credited, like in this second journal entry. The difference over here is I now know what my revenue number is. It's 500 times 48. That's what they've told me the revenue number is. On this amount, I collect 6%, or I will have to collect 6%. So 6% of 24,000, that total amount I will collect is represented in the accounts receivable, 25,450. Now that I have all of this done, I've been told that this is the information about payroll. I'll get to that. Now in the problem, they've told us to first journalize the transactions in January. We've done that. Then they've asked us to do the adjusting entries at January 31st for the outstanding note payable and for the salaries and wages expense and payroll taxes. So there are 3 journal entries we need to do. So let's first start with the note payable. So the note that where we had borrowed $18,000, it's due in 4 months. So it's not due right now. However, I need to accrue interest on the note. So in the journal entry, I will debit interest expense and I shall credit interest payable. It was 5% per annum from January 1 to January 31. 1 month has passed. So the calculation is going to be the face value of the note, which is 18,000, times 5% times 1/12, because only 1 month has passed so far. So that dollar amount is $75. So this interest is accrued. I owe this money. I have not paid it right now. I'll pay it at the end of 4 months. Along with the $18,000, I'm accruing interest at the rate of $75 per month. So I've done the first month's journal entry. Now let's take a look at the salaries and wages expense. So here we've been told that during the month of January, our employees have earned wages of $70,000. So I know salaries and wages expense, $70,000 is the amount I need to debit. This is not the full amount I'm going to give them by way of paychecks. I'm withholding certain dollar amounts based on agreements with my employees. And these are all taxes in this case. So the withholdings related to these wages were $5,355 for FICA. So it's going to be FICA payable. FICA is Medicare and Social Security tax. They've told me the amount is $5,355. Another $5,000 has been withheld towards their federal income tax. This is the employees' taxes, personal taxes. And I have $1,500 in state taxes that I'm withholding on behalf of my employee. So after all of these deductions are made, the amount I am going to pay them That is, the check I'm going to write out to them is $58,145. The total expense for me is $70,000 over here. This much money goes to the employees, and the remainder goes to different government agencies on behalf of the employee. So when I withhold these monies, I'm withholding it on behalf of the government, and I need to give the money to the government. I need to remit the money to the government until such time it'll sit in my books as a current liability. Now, we need to keep note of this FICA tax payable. We all know the employer and the employee pay an equal amount. This $5,355, I need to pay it as well. Let's see what else is told over here. The company owed no money related to these earnings for federal or state unemployment tax. If you recall, for the unemployment tax, it's only on the first $7,000 per employee. So the assumption made over here is all our employees, this paycheck of 70,000, they've all exceeded the 7,000. So I don't have to worry about that. So what I do need to worry about is the FICA taxes. So I will have payroll tax expense and FICA payable. This is my portion. This is the amount that the employer has to pay. So for the employer, the total expenses, salaries and wages expense of 70,000 and payroll tax expense of $5,355. So that's the total cost really of keeping the employees on the payroll for 2 weeks. So now that I've done all my journal entries and adjusting entries, I'm ready to move to the next step, which is posting into the various T accounts. So as I told you, I already have my first 3 T accounts set up with the beginning balances, and we are concerned only with our liabilities. So when I'm doing the posting, it's only partial posting. I'm going to ignore the other account that is debited or credited. So the first one, notes payable, is going to be credited. We didn't have that account, so I created, and I have notes payable credit of $18,000. In the second journal entry, I had sales tax payable credit. I already have a sales tax payable account, so I obviously use the same account, and I post the credit of $354 there. And the third transaction, unearned service revenue decreased. The liability decreased by $10,000, so I posted on the debit side. The next journal entry, I paid sales tax of $6,600. So again, the liability decreases, so I debited. I'm posting that amount. In the next journal entry, I had sales tax payable. But again, now I'm going to record the sales tax payable, so it's credited $1,140. And then in the adjusting entries, I had interest payable. So that's a new account that I need to create over here. Interest payable is credited $75. And then we have a whole bunch of payroll related liabilities. So let's look at them. I have FICA payable, that's $53.55. Then I have the federal unemployment tax, federal income tax withheld on behalf of the employee, and the state taxes. Again, these are all coming from the journal entries, the adjusting entries. And then I have salaries and wages payable. I still owe my employees the money, the paycheck that they are going to get, that amount. And then in the last adjusting entry, again, it's FICA payable. I use the same account that's already there. So this is a double FICA that you have over here, the employee's portion and the employer's portion. Now, once all of this is done, I can just go ahead and calculate the balances. So they also specified and said there were no changes in the accounts payable account, so that stayed as is. Anything with a single entry in it, I'm just going to single posting. I'm going to draw a double underline to indicate that's the balance, which is usually the case for most of these accounts. And then the ones that have a debit and a credit or multiple debits or credits, I will do the needful for FICA payable. There were 2 credits. For the unearned service revenue, it dropped to $9,000. And for sales tax payable, I need to go to the calculation, add up both sides, and then take the difference to arrive at the 1794 as the balance for that account. So let me quickly do these just draw the lines here to indicate where we're getting these numbers from. Okay, so that's just a little bit of a presentation format that I'm particular about. Now that I have the balance in all the accounts, I'm ready to prepare my balance sheet. Again, remember, this is just a partial balance sheet that we're preparing. We don't have all the information to prepare a complete balance sheet. But still, we have to stay true to form. Start out by writing the name of the company, name of the statement, and then in parentheses, we are going to write the word partial. Then we write the date, which is January 31st. And then we'll write current liabilities. Now, there is no particular order in which you list your liabilities. I've just listed them in the order in which they appear over here for me. Sometimes companies may list them in the order of magnitude. That is the largest one first, and then it drops down. Some list it alphabetically. The entire point is, in classification, make sure that all of these have been classified as current liabilities and not as long-term liabilities. That's important. So how we present within this category, it's really not significant. So in this exercise, we've seen how the liabilities come into our books, how we incur the liability, how we pay off the liability. You could pay off by paying cash, or in some cases, you could perform the services, and that's how you're paying off the liability. Again, the focus has to be you're using something that is current to pay off these liabilities. So once we're done with all of this, we know where we stand at the end of the period in terms of the current liabilities. Again, since I'm going to use current assets to pay current liabilities, it is very important in terms of planning for the next month to see if I have this money available the next few months, because some of them are not due next month, as in the case of the note payable. But you want to keep a track of your liabilities, because these are all commitments and there are legal obligations, and there are legal consequences if you cannot make these payments in the next month. So this concludes the topic on current liabilities.